All right, so government grants is the first topic that we will do. It's very easy. There are basically two types of grants, asset-based and income-based, and the information that you will get in the question will lead you to apply the correct rules with regards to which government grant you have to do. All right, so the basic government grant accounting statement gives us government assistance, and then we have government grants. Right, so government assistance, we only disclose in the financial statements. So there's no calculations or anything. So we just say government provided us with some assistance. We'll look at what government assistance is just now. So there's no calculations, it's only disclosure. Government grants is where there's a flow of money or assets. There we have to look at the recognition and the measurement of that government grant. And then we also have to disclose the government grant in the financial statements. All right, so there are two basic principles here, government assistance and government grants. And then the actual government grants can be income-based or asset-based. All right, so government assistance is basically direct assistance where infrastructure is provided to the company by the government. All right, so we want to do training. We don't have money to buy or lease a building, and the government provides us with a building. So it's direct assistance where they give us the infrastructure or the building to do training. Or they can provide us with a piece of land that we can farm on. So it's not our property, it's not our asset, but they just provide us with assistance to help us to do something to help the community. All right, so government assistance is an action by government to provide some economic benefit. We get an asset to use. It's specific to the entity, so only your own entity can use it. And then there are certain qualifying criteria that must be met. We have to train 5,000 people a year. We must use it for at least 3 years, whatever the case may be. So those qualifying criteria will be part of that agreement for the government assistance. So all we have to do is disclose in the financial statements that we have received some benefit of government assistance, but explaining the nature, the extent, the durations of the assistance that we have received. So the nature is we received a building that we can use for training. The extent is that we use it for training or whatever the information is that is given. And the duration is 3 years, 5 years, whatever. And we disclose in a financial statement that government has provided us with some assistance to do something in terms of this government agreement that we have with them. All right, so government assistance is very easy. There's no calculations. It's only the disclosure of the information. Then we have government grants. All right, so government grants was introduced because South Africa has got quite a bit of unemployment and they want to discourage the use of machines, and therefore government provides companies with grants to employ more people instead of buying machines to replace the people, or you buy additional machines to employ more people to operate those. All right, so government grants, how do we do that? Government maybe will provide an incentive to pay salaries than rather to buy the machines. So if we have 10,000 people working for us and we want to lay off half of them because we want to buy a machine to replace those people, government says, let's rather give you an incentive and we will pay part of the salaries instead of you buying a machine. All right, so it's a physical transfer of money or assets between the government and the company. So the assistance here by government is in the form of the transfer of resources. So it can be cash or assets. So remember, there must be a transfer of resources. We want to buy a building. or we want to build a new manufacturing plant, and government provides us with a grant to assist us with the purchase of it. Not the whole building, but they give us 20% of the cost price, for instance. And that's a transfer of resources that we will use to buy the building. All right, it's also linked to the entity, and in exchange for past or future compliance with certain conditions relating to the operating activities of the entity. All right, so transfer of funds or assets to a certain entity, and there are certain conditions that must be met. So we need to use this building to train people if this is now with government grant, not assistance, or we must build a manufacturing plant and we have to use it for 5 years to employ more people to generate more workers that we can pay. All right, so all of this is government grants, and we would do something that we would normally not have done if we did not have this grant. All right, so government provides us with the resources to do it. We can't recognize the government grant if it is not sure or reasonable that the entity will comply with the conditions attached to the grant that we want to receive, or that the grant will be received. All right, so all of those conditions must be met before we can recognize the grant in the books of the company. So we will recognize the government grant as income over the period necessary to match it with the related cost which it is intended to compensate on a systematic basis. So when you think of depreciation, depreciation is the write-off of the asset over the useful life. It's a systematic basis how long we think we will use this asset for. So the government grant uses the same principle. We recognize the grant income based on the period that we will use the grant for or use the asset for. All right, so it will be 5 years or 20 years or whatever the case may be, and that information will be given. So important here is to remember it's on a systematic basis, and we recognize it as income over the period necessary to link or match the cost of the asset that was purchased, or the income-based one where we subsidize the salaries over a certain period of time. So government grants can either be asset-based or income-based. So when you have a question, you must always look at what are we trying to buy here that the government grant is going to subsidize. Are we going to buy an asset? Then it will be asset-based. If it is going to subsidize research costs or salaries or some other expense in your income statement, then it will be income-based. So which one? What cost are the grant meant to cover? If we're going to buy an asset, PPE, then it will be asset-based. If the grant is there to subsidize a salary or some cost of sales or research cost in the income statement, so if it is linked to an expense, then it will be income-based. So our expense will be less because we get the subsidy from government. So you must look carefully. Is it asset-based or is it income-based? If it is asset-based, then the grant's primary condition is that the entity should purchase, construct, or otherwise acquire a long-term asset. So when the question says we have received a grant from government to buy a new manufacturing plant or to build a new manufacturing plant, or we want to buy a machine, because that machine is a long-term asset, it's part of PPE, and then we will use it as an asset-based grant. All right. So asset-based, when we receive the monetary funds, that asset-based grant can be accounted for in two ways, either as deferred income or a reduction of the cost price of the asset. So now you have government grants can either be income-based or asset-based. If it is asset-based government grants, we must now see what the question or the information tells us. How do we account for it? Do we show it as deferred income, or do we show it as a reduction of the carrying amount of the asset? If it is deferred income, we recognize it as income over the useful life of the asset on a systematic basis. So now we bought an asset, we're going to depreciate the asset over 20 years, and the government grant, that will also be shown as income over the useful life of 20 years of the asset. So we link the government grant and the asset together, but because we use deferred income as the method to account for that income from the government grant, we use the useful life to calculate how much of the government grant we can recognize each year. If it is a reduction of the carrying amount of the cost of the asset, then we recognize it as income over the useful life of the asset by the reduction of depreciation. So you will see in the two examples that we will do, the net effect of these two methods, deferred income or a reduction of the cost of the asset, the net effect on the income statement is exactly the same. If we have deferred income, then we have depreciation based on 20 years. And we have other income that is transferred from deferred income, the government grant income, to the income statement over 20 years. So we have depreciation as an expense, and we have got income from the grant as income. So the expense and the income is offset against each other to get a net effect. If we reduce the carrying amount of the asset, what does that mean? Cost less the government grant gives us the amount we're going to depreciate. So our depreciation is going to be less. And because both of these must be over the same useful life of the asset, the net effect of both methods in the income statement will be exactly the same. But I'll show you when we get to the question. All right, income-based grants. We either show income-based grants as other income, or we offset it against an expense. So remember, income-based grants is linked to some expense on your income statement. So we have a government grant where they are going to subsidize the salaries, or they're going to subsidize our research cost, or any other expense in the income statement. So now, because it's income-based, it is linked to an expense in the income statement. So we either offset it against the actual expense. So we're going to credit the expense with the grant income, a certain amount for that specific year, or we're just going to say leave the expense as it is and show the portion that we recognize as other income. All right, so the principle, the amount is exactly the same. It's just where we write the journal to. It either goes to the actual expense or it goes to other income. All right, repayment, we're going to leave because there's no time to do repayment. All right, so class example 1 is in the study pack. So I'm going to open a study pack because the question and the answer is there. And class example 2 is the next slide, which is also in the study pack. And then we're going to look at 2 small questions quickly. Are there any questions before I go on with the examples or the 2 small questions? Are you all with me? All right. Just on the study pack, I'm using the same study pack that we had last year because all the recorded videos are linked to the page numbers of the study pack. So you'll see it says 2023 and our subject code, but it is linked back to the original study pack we had because of COVID. But everything is here, but you will see it only starts on page 90, whatever, because the first couple of pages was just other information that we included for COVID in that year. So they are all the page numbers. So when I refer to page number 283 or 102, it refers to that page number at the top of the study pack. All right. So don't look at number 1 that you have there. That is just the page number of the original document. And I didn't take that out because I combined everything together. We only look at those page numbers that we have in the study pack. All right. So government grants. All right, example 1. A Limited received a grant of R1 million from government. The provision of the grant was that A Limited constructs a manufacturing plant in a rural area for job creation. Okay, why do we have grants? Because we want to create jobs. You see there's a grant. That's the amount of the grant. And we also see that we have to construct a manufacturing plant. So in this question, we can see that that refers to an asset-based grant because we have to construct a manufacturing plant. It's not linked to an expense in the income statement. So when you have information on government grants, the first thing you do is you see, is it income-based or asset-based? In this question or this example, it is asset-based because it is linked to a asset that we will use for PPE that we have to purchase. All right, so the plant was completed and ready for use on the 1st of January, and the cost was 5 million and had an estimated useful life of 25 years. So we will write off the plant over the useful life of 25 years. So that is what we use for depreciation. Straight line method in terms of PPE, and it is the accounting policy of the company to account for the grant related to assets as deferred income. So the question will tell you how to account for the government grant. So because it is deferred income, we will calculate the income from the grant over the same useful life of the asset. Okay, just to go back one step, remember, when it is an asset-based grant, we can either show the grant as deferred income, or we can offset the grant against the cost of the asset. But in this example, we show it as deferred income. So that means we will use the assets cost, depreciate it over 25 years, and we will use the deferred grant income that million of the grant, and we will calculate the income from the grant and defer it over 25 years, the same useful life as the asset. So it's important that you read how we account for the grant. Is it asset-based or income-based? If it's asset-based, do we show it as deferred income or deduction of the cost of the asset? So in this one, There's our cost. There's the grant. Okay, that's the, just change that. Sorry, that's the deferred account. Right. So our basic principle is cost of 5 million and the grant of 1 million is accounted for by using the same depreciation rate, because the asset's useful life was given as 25 years. So we will use 25 years to calculate depreciation and other income, and we will account for it. So each year, our depreciation is going to be 200,000 because it is cost of 5 million divided by 25. And that is now, remember, accumulated depreciation. So in year 1, it's 200,000. In year 2, it's 200 plus 200. In year 3, it is 200 times 3. And that gives us the 600. Deferred income, the grant income of 1 million, is also accounted for over the same useful life of 25 years because we must link the asset with the grant. So 1 million divided by 25 gives us the 40,000. So each year we will recognize 40,000 on our deferred grant income. So 40,000 goes to the income statement and 40,000 goes to the deferred grant income account. So the opening balance for the deferred grant income is 1 million less the 40,000 we recognized. So remember, deferred grant income is a credit account of 1 million because we debit the bank when we get the money and we credit the deferred grant income account. Then we recognize the first year and we're going to say year 1, debit 40,000 to deferred grant income, and then other income or grant income in year 1 is 40,000. All right, and that's where that 40,000 comes from. Oops, sorry. Okay. So the net effect in our income statement, that's the expense, that is income. So the net expense is 160,000. All right. So that is where we have a grant linked to an asset and we recognize the grant as deferred income. Example 2 is exactly the same information. It's a 1 million grant, 5 million cost, but the only difference now is that the grant is accounted for by reducing the cost of the asset. So now we're going to say cost less the grant received And that gives us the depreciable amount to use. And that is the difference between the two. So here you will see, now we have the cost of 5 million, less the grant. Can't remember what color we use now. Let's just use the colors on this one. Red is the cost. Grant is a million. And our depreciation rate stays 25 years. So now what happens? Now I'm going to say 5 million less a million gives me the actual cost of the asset after we have accounted for the grant that we received. 5 million less the grant of a million gives me the depreciable amount of 4 million, and we divide that by the useful life of 25 years. So each year, the depreciation is now 160,000. So year 1 is 160, year 2 is 320 because it's 160 times 2, and year 3 is 160 times 3. So can you see that the net, the net effect here, sorry, my finger was sweaty and it touched the page. So the net effect on the income statement, statement of comprehensive income, 160 expense per year. If it is asset-based, and we reduce the cost of the asset. If it is income-based and we write off the asset over a useful life of 25 years, and we recognize the income from the grant from deferred income to other income, also over the same depreciation rate of 25 years, then the net effect is also 160. So the two method gives you the same answer in the income statement. It is just how we account for it that is different. All right. Are there any questions on those two? Because that is the basic principle of asset-based grants, where we have either income-based, deferred income, or a reduction of the cost of the asset. Any question on those? Are you all with me? Okay, so then we can look at the disclosure, for example, 2, and you will see that this disclosure looks a little bit different now than what you are used to. This is the newer disclosure for fixed assets on the balance sheet. So you must please make sure that you can do the disclosure like this. Please mute your mic. Sorry, sometimes this thing uses the line that is already there. Let's try again. Right. So remember quickly do something. So I've got to print a blank page. So, okay, remember previously, how did you do the PPE note? We had carrying amount, opening balance, cost, accumulated depreciation. Then you had additions, depreciation, disposals, revaluation. And then we had carrying amount at the end of the year, cost, accumulated depreciation. All right, so everything was underneath each other. So that is the prior year. This piece was your recon for the year. And this is the current year end balances. That is how the PPE note used to look previously. So all we do now is that prior year portion is now the blue. So prior year is on the right-hand side. So I'm basically just saying, sorry, that information there, I'm adding and I'm showing it on the right-hand side. The current year closing balances in the purple is at the bottom of your old disclosure. And in the middle part, instead of having it underneath each other, we are going to show it as next to each other. So the recon for the year is this piece here. So opening balance carrying amount comes from the prior year, and that we also used to disclose in the previous one. So it was cost less accumulated depreciation gives us carrying amount at the end of last year. That is the opening balance carrying amount, the light blue that we have for the current year. We did not have any assets last year. Then we bought the new asset for 5 million. The 5 million is the cost of the asset that we purchased. And then we have to deduct the government grant of 1 million. So cost of the asset less the grant. And please remember that in the note, PPE note, you have to disclose that you have received a grant. So you show the addition as 5 million, although you deduct the grant received from the cost of the asset, and you disclose the grant. We calculated the depreciation for the current year as 160, and that was 5 million less 1 million to give us 4, and that is now the new basic net cost of the asset divided by 25 years. So depreciation for the current year is 160. So 5 less 4 gives us the 4 million net cost of the asset, and that is those two together. Less the depreciation, we only have depreciation for 1 year at the moment, and that gives us the carrying amount at the end of the year. And that is also the carrying amount at the end of the year. So current year depreciation of 160 is taken to accumulated. There was no accumulated depreciation last year. So 0 plus 160 in the current year gives us accumulated depreciation at the end of the year. All right. So it's just a little bit getting used to this disclosure, but it is the same information that you used to have for the old disclosure. It just looks neater. We have current year, prior year, and then the recon in the middle where we show opening carrying amount, additions, grant received, disposals, revaluation, depreciation, impairment of asset, or whatever the case may be. Okay, so just remember to check the disclosure for that one. All right. Are there any questions before I do question 1 and 2 quickly? They are very easy and fast. All right, question 1. ABC acquired machinery on 1 January for 550, and doing so they qualified for cash subsidy of 200,000. ABC accepted an accounting policy to depreciate the machinery over 5 years on a straight line basis and to account for the government grant as deferred income. All right, what's the first thing we have to look for when we have government grants? Is it asset-based or income-based? This is an asset-based. Why is it an asset-based grant? Because we have to acquire a machine, and because we acquired the machine, we received a subsidy of 200,000. So the grant of 200,000 is linked to the purchase of an asset. That is why it is asset-based. How do we account for the grant? The grant will be accounted for as deferred income. So we will calculate depreciation based on the cost, and we will calculate the other income received from the grant each year based on the depreciation rate, because the rate should be exactly the same. All right, so cost of the asset is 550. We debit the asset and we credit the bank with 550. Then we receive the grant. Grant is 200,000. We debit the bank because the bank will be more, and we credit deferred grant income account. Remember, deferred income is on the balance sheet. All right, because it is income we will defer over a period of time. Because we use the asset-based grant and the income recognized from the asset-based grant as deferred income over the useful life of the asset, we will calculate the depreciation only by using the cost of 550 and the depreciation rate of 20% per year. All right, so remember, 100 divided by 5 gives us, gives us 20%. So 5 years and 20% is exactly the same. All right, so depreciation is 20% per year because they give us 5 years, and that gives us the 20% per year. We did not deduct the grant received linked to the asset from the cost of the asset, because the government grant is shown as deferred income. So if it is deferred income, each year as we depreciate the asset, a portion of the grant income is recognized in the income statement. So we transfer from deferred grant account to the income statement. So deferred grant is on the balance sheet, and we will debit the deferred grant account on the balance sheet to make it less, and then we show other income or grant income in the income statement. Let's get it blue. Okay, so the grant was 200,000. It was the light gray, divided by 5 years. And 5 years is what? That is the useful life of the asset. So you always link the grant amount that you will recognize to the useful life of the asset. That is the expense of 110,000. That is income of 40,000. If the question said deduct from cost of the asset, what would we have done then? Then we would have said 550 cost less the 200,000 grant, and that gives us 350 net cost, and we will depreciate that over 5 years, and that will give us 70,000 depreciation per year. There is, or it's not in this question, I'm just explaining that if the question said deduct from the cost of the asset instead of showing it as deferred income. 550 is still the cost. 200 is still our grant income. And then we use the useful life of 5 years to calculate depreciation. So can you see if we do that, where we deduct it from the cost of the asset, the expense in the income statement is 70,000. And that is the same as those two, expense of 110 and income, sorry, of 40,000. So it is the same information, just different accounting. Then question 2 is very quick and easy. TUT Limited was awarded a government grant of 100,000 to subsidize future wages. 30% of the wages will be subsidized. Is this income-based or asset-based? This will be a income-based grant. Why is it income-based? Because we are busy subsidizing an expense in the income statement. The grant is 100,000. So we will take that to deferred grant income. And each year, 30% of our salaries can be written off against that grant income. So for the current year, salaries or wages incurred was 200,000. So 30% of that will, sorry, page is now not working properly. 30% of that will be subsidized. All right. So in the current year, we can say our salaries is 200,000 and we received a grant of 100,000. So bank is more, deferred grant income is credited. Remember, deferred grant income always refers to the balance sheet. Now we have to say how much of the grant can we recognize in the current year. So because the grant subsidizes 50% of my future wages, sorry, this thing, I need to do that first. There we go. 50% of my wages is subsidized. I can say 50% of the 200,000 staff cost is subsidized for the current year. So I can recognize 60,000 in the current year. I debit deferred grant income with 60, and this is offset against the cost of the asset because the question said represent the grant as an adjustment of the expense. Remember, if it's income-based, I can either offset the grant income against the expense or show it as other income. So here it says we offset it against the expense. So that's why staff cost is credited. So I will make the staff cost less with 60,000. And deferred grant income is debited with the 60. Since that one. Okay, so what do we have on our balance sheet? So we have deferred grant income, 100,000. Staff cost was 200,000 and we recognized 60. So the net expense is 140. And year one, we recognized 60,000. Right, so that means our balance left on the deferred grant income is 40,000. So if we balance the account, it is 40,000. Okay, so you can see that we received a grant of 100,000. We used 60 of it in the current year. So the balance left on the deferred grant income for the next year is 40,000. Each year, we can recognize 50% of our salaries. So if year two is again 200,000, we would want to recognize 50% of the 200,000. And 30% of 200,000 gives us 60 again. But we only have 40,000 left in that deferred grant income account. So what does that mean? For the year 2, the amount we can recognize is limited to the balance on deferred grant account. So although we want to recognize 60,000, because year 2 salaries again was 200,000 and we recognize 50% of the cost, we only have 40,000 available on the deferred grant income account. So for year 2, we can only say debit deferred grant income account with 40,000. Otherwise, you won't have the correct accounting to do that. Okay, so that's the basic principle of our government grants. So when you have government grants, asset-based or income-based. Asset-based, deduct from the cost of the asset, or we show it as deferred income over the useful life of the asset. If it's income-based, we either show it as other income or a deduction of the cost of the asset. All right, any questions from your side?